dropped down, and he's like, "I should have stayed in." And I said, "Yeah, you didn't want grief, and now you want to complain about it. That's gratitude." Anyway, so anyway, there was a redaction on the news article, so you'll probably be seeing that shortly. But it did go out on a few of the news wires. So yeah, unbelievable that it actually said FDA approval. And for those that didn't see that, let me actually show you. Here's two of the posts, and total fabrication is what these are. Okay, that is a false publication. This is a false publication. What's the other one? All right, so the first one says FDA approval of XPOVIO. It's not an approval. There's an approval for fast track on a drug, not an approval of the drug. Okay. Next one, another false statement. Two of them. So anyway, so I there was posts before this. These are posts that these were posts before that. There were posts before this that actually had came out in Twitter and a couple of other places. That's the reason for the rise. Then these posts were put out to try and show that it was correct. Now there's going to be new posts put out saying that this was all for a fast track for drug approval. So just for clarity. So when that comes out, I'll post those so you guys can see those. Anyway, so my comment was, well, if this takes off on misleading and false news, then what is the recourse? Like SEC filing or something. Anyway, didn't go anywhere because then it started to leak out that it was just for drug approval, and so he got out, and his total loss $4. Yeah, so I think that's a celebration in my mind. Yeah, well, no, actually, there's two of the releases came out from Benghazi, and they've already been pulled back, so you won't see them now. They're not in here. And had I have recorded it, you would have seen they were both in here. They're just not. They're not in here right now. But they were both the Benghazi releases were actually were in this the same one. This is the same one. It's just I just picked two of the most recent ones. But anyway, so yeah, I'm just glad he stopped crying and stopped. I think the guy was getting suicidal. And I didn't help him because, dude, this is how much you're going to lose. Tough it up. Yeah, sometimes I don't know. I don't know enough to keep my mouth shut. But anyway, so he's out. Yeah, and ultimately it was nothing but a pump on the stock. Yeah, it was a guy was getting pretty emotional. And I told him, I said, dude, I don't know what to tell you. I don't have control over this stuff. And I started, well, you've helped other people with this and this. Yeah, no, I've helped other people. I didn't do anything for them except for console them. Anyway. All right. So, all right, what we were going to talk about, like multi-frame time frame. All right. So like here, this is the basically the workspace that I actually want to share with you guys. I wasn't done setting up a couple of things in here. I haven't put any time into it. That's why it's not done. Yeah, it happens in Willie's. It happens with Will all the time where he's taken, and I emphasize this several times. You don't trade short on FDA on phase 3. You don't trade short on FDA approvals, and you don't trade short on PDFAU. And if you trade on any of those three, you're playing with fire. And I don't understand why people continue to do that. You never buy a stock to take a long position that's already moving up. You have to make that you have to have a rule. I have a 4% rule. Okay, I have two different rules. I have a 4% rule and a 5% rule. And so if I move to a certain point, I don't go in. If it goes back below that point, I get out. Yeah, yeah. And the truth is that I've told him. I said everybody that gets burned a couple of times like this will begin to realize that if they keep doing what they keep reading and they keep doing what they keep observing, and they're expecting to change, well, then they're a fool. Now, I don't think you like being called a fool, but that's what it is. If you're a fool, if you think that you can keep doing the same thing and you expect a different result. Anyway, all right. Multi-time frame. Okay, so like in this one, this is for your intraday type scalp. All right, but this is for these ones here are basically for your multi-day swing trade. And so I like to run a daily, I like to run a weekly, and then I like to run. Uh, so this is literally days, this is weeks, and this is the minute. And I'll go back and forth between 1 minute and 5 minutes. So I'm not fixated on one or the other. Um, Again, like I was saying yesterday, I like to get my signal for my 3 weekly here. Now, if I like the SPY today was up here pushing the top. Okay, we have a white dot here. The SPY is up here pushing the top, and we have a white dot. So, but let's look at these values. When I put the mouse over this, well, you can see right here. If I put the mouse here on the screen, that both of those are below. Okay, these two bars, sorry, are below this bar, and that's what you want to see when you're looking for a ski slope. You're expecting things to go down. So here we see it going up, and it's kind of in divergence to what we're seeing here on the histogram. And there's a reason for that. So let's figure out what that is. So right here, if you look at that value right here, and I can't read it, I think it's 674.00. So 674, and this one is so maybe 664. You can see this one's a little bit lower than that. For me, the only way that I see this SPY going more, going higher, of course, you got to remember, anytime something like the SPY or a good stock, a love stock is going higher, people always buy on at the high with the expectation it's making a newer high. And there are traders, that's their whole strategy. So you keep that in mind, because those stocks also impact the SPY, because people jumping on those stocks drag the SPY along with it. So let's look at it. Had this been higher than this bar, okay, then that would have been some kind of confirmation of it going up. Now, even with all that, there's not a chance in the world I personally would jump on this trade going long, okay, because I am kind of similar to Andy. I think, when you get to a high, you'll tend to have some consolidation, some pullback, some profit taking. And especially when you're pushing the limits of the Bollinger Band. So looking at this in the daily is telling me a story. Okay, it's giving me a kind of an idea of what's going on, and I'm interpreting the story the way I see it. Okay, I'm also seeing decreasing volume, and I expect the volume to be low. Today was a short day, but decreasing volume is indicative of some significant change that's going to be coming along. But then we have the same thing. Now remember that this is not a whole week. So this bar, when you look at these bars, this last bar, you can't use this in the interpretation of your data and to near the end of the day on Friday. And if you have a missing day, like we're going to have a partial day, then this volume can't be used to be comparing to these other weeks. But here we have the same exact scenario. We have a white. We have, this blue is higher than this blue. This blue is higher than this blue. This blue is higher than this blue. So we have this very well-defined slope. Same thing, same slope. All right. I mean, if you look at it here, we're pushing the edge of the Bollinger Band. All right. On this one, we have a smaller view. Let me zoom out. All right. So both studies. This is what I like to do. I'll do it this way to go to the time period. So right here, if you look, okay, on this one, I'm running 3 months. You can run 6 months or 3 months. I like to run 3 months. On the weekly, I like to run it a little bit longer. I like to run 6 months out. Okay, so if we look at this, over here we went from the low and we went and tagged the other side, and now we're just running along the top. We're not en route across the fair value line. There's nothing here that to me is saying that this is a trade that I can take or would take. I'm not trading in the trend. I'm not just jumping on because it's going up and I expect to go up. I don't make those trades. Some people do. Over here we have the same identical things going on. I mean, we were way over here. We were down. We didn't quite make it to the bottom of the line, but now we're going up. Uh, we haven't really hit, and then we hit here just now, right? So remember, each time we hit, we tend to pull off. Each time we hit, we tend to pull off, and this is common. Go look at the Bollinger Bands. You'll see that sometimes, and I'll back out here, you'll see that it will run along it. And excuse me one second. Sorry, I thought I was going to sneeze. All right, so running along this to me is there's no trade here. There's not a trade that I want to take or would want to take. Okay, it's just nothing there to me is appealing, especially when the histogram is in the same direction. I can't find a good opportunity to get in and uh, take the leverage of the bounce, basically the move away or across, meaning across or away means it could be just moving off like something like this, kind of a slope down. But anyway, so here both sides, both Bollinger Bands, we're seeing the same activity. We're at the top. We're at the top. This is multi-time frame. These are telling us the same story in two different time frames. We also have the white dot in both time frames. Okay, we have the slope going down in both time frames. Everything that I'm looking at in here, uh, this is a witness. This is a witness. Sure, it's not like a white dot right up on it. Okay, but rarely does that happen on the what I call the ski slope. But we are above the fair value line, and we should be seeing it come back down through. We are above the fair value line, and we should see it come back down through. And however, with before last time, it didn't come down. Okay, it just kind of went a little bit sideways. But we weren't at a green candle neither. And often you'll see either you'll see a red candle with a long shadow or a green candle, and then you'll see the next candle pull back. And so when you get a chance, look at the daily, look at the weekly, and look at the daily, and look at the colors of the bars. And when it pierces the Bollinger Band, what color it is, and what types of candles are they? Like, is the one on this side usually red with a long shadow? And when it's not, is it green? What does it do? And these are good clues as to what's going on. And you can reference that and graph after graph, chart after chart, whatever you want to call it. All right. So here we're at the high, here we're at the high. Obviously, we're at the all-time high. Okay. Going in after hours, it started to go up. So it's a little bit of movement up. Now it's the wrong day. Sorry about that. Something didn't look right there. Now I know why. All right. So we hit actually we hit the high. I think it was right around here, or it could have been here. I don't remember. And I said something about, yeah, this might be a good time to go short, or something along that line, or there's white dots in daily or white dots in weekly, or something to that effect. That doesn't mean that I'm going short right then and there. If I'm going short on something like this, I'm going to put going short. if I just put short, I'm just implying that's the direction it's going. So I try to be clear on some of these things when I am going to take a trade. What I don't really want to do is post the size that I'm trading, because I want you guys to use a little bit of discipline while you're learning. All right, so here, it made it up here and it started to drop down, and we had a couple of rogue candles, for what I call rogue market orders, and those things happen on short days. They tend to always be there. So now, what is the outcome? I don't have a crystal ball, but I have to play probabilities, and a, a swag is a silly wild ass guess, and without actually going and taking all the information from both of these and going back and comparing it right now, all I can give you is my silly wild ass guess. Now, I will tell you, I trust my silly wild ass guess out of most market analysts and the guys that I often call monkeys, and because they just swing from branch to branch. They're getting paid to push a narrative. They're getting paid to promote change the price target. These guys are getting paid, and so I don't care about what any of them have to say. Uh, generally I don't care. But so here, we have a story. There's a story here, and how you interpret that story should be based on historical references. If you just try to base it on its own merit, you're making a mistake. So always try to use some kind of reference. And I don't know how many times I've already said to you guys, I don't like I when I see I pointed this out before on the bottom, like when I see a curve like this that has a different meaning than, if it's just like an isosceles, just a perfect triangle, right? Or an inverted pyramid. So something like this side is good to see, but then when you see something like this little curve in here, yeah, I don't like to see that. Okay, but if it were straight, if it were just a straight line, I call that just a straight ski slope, and that typically means it's going short. But when you have a ramp up, the next thing you know, the next blue bar could be a cyan blue right here, not a dark blue, and it can take up and just end up being one of these, just pushing the Bollinger Band along the top. So this is right now, it's watch, not trade, but definitely this is spies on watch, not trade, both on the weekly. Okay, watch, not trade, watch, not trade. Okay, on the intraday stuff, again, I told you guys already, if you're going to do an intraday scalp, if you don't have a clear push up and then off, then the trade is it's going to follow and basically keep pushing along the line, and you'll take that trade. Yeah, yeah, and I'll be honest with you, I'm not expecting. I think the numbers are going to be totally off on the report, so the market is going to be violent. Okay, uh, and that's one of the reasons why gold had an. I have a strong interest in gold. However, I did not see the opportunity. Uh, the opportunity that I wanted to enter didn't present itself, and we're gonna work on your discipline here, V. uh, patience, patience. I mean, that's the only thing I can say. But I, I am interested in gold. Part of the gold is going to be related to the employment report. Okay, I got a feeling the numbers are going to be way off. I am very good at crunching my own numbers, and the estimated numbers are not the numbers that I'm getting. I don't know where the hell they got their numbers from, but I have some estimated numbers from some data that's readily available, and I think their numbers are are about 8% off. That's a big number. I don't believe that anybody's right here on whatever's coming out on that report. It's going to hurt the market. Okay, so the market is likely to be very explosive on Friday, and gold to me, when unemployment claims, uh, you know, hit a higher than at normal number, and numbers are skewed in the employment report, you usually see things like gold take off, right? So you also see oil drop. So you kind of see that comparison between the two. And yeah, yeah. Honestly, there was one day I was going to do a trade, and I think V asked, "Are you in yet?" No. Are you in yet? No. An hour later, are you in yet? No. And it wasn't like into about 3 o'clock. Are you in? I'm getting ready. All day. I mean, it was all day, and it's like when it's ready, it's ready. I don't jump in out of the fear of missing. It's either what I need to see to feel good about the trade, okay, that complies with my rules, or it doesn't comply with my rules, and I don't take the trade, even if it goes, even if I missed it and it was right, I don't care, okay, because if I run a test and I compare, for me, I have a big sample. I can look at 100 records, and I can tell you anytime that I made that jump without being the perfect setup, I regret it. I don't make what I want to make. I either and I or I come up with a wash, or I break even on the trade, but then my fees, I got a couple $100 in fees, and I don't like paying fees without having anything to show for it. I'd like to at least win a dollar over the fee if I'm going to have to take a wash. So anyway, yeah, patience, patience, patience. So yeah, multi-time frame is important. Now you can go on scalping. You have a couple different ways to deal with the scalping. I like to use the 1 minute. Like if I were in this trade, I stay in this trade until I either get a good curve down, or I get that intersection between the green and the red with 1 bar, and that to me is what I like to see. And it doesn't matter if a couple bars down, let's say a couple bars later, the lines separate back out, because that's what happens with a lagging indicator. It doesn't matter if that's what I'm using to say I'm getting out, then that's what I'm using to get out. I just don't use it for entries. It's a terrible thing. You do not use any kind of moving average for an entry. It just simply is the wrong type of tool to use for an entry, because you're going to give up 3-4 bars. And depending on ATR, those 3 or 4 bars, it might only take 9 bars to fill 2 quarters, and I'm going to lose 3 or 4 bars on a lagging indicator. Hell no. So that's why, say using which you guys saw, some of you guys saw today, several times. We had a couple different stocks, either tag this line or tag this line, and it would tag and bounce off, or tag and bounce off, and one hit it a couple times and finally broke through. All right, but the risk is, when you pull back and it's going against you, you have to make the decision, based on whatever your risk management is. Or like Andy today, I accidentally ended up doing a double order, and those happen. Uh, I I remember Cameron doing that several times, banging on his hotkey, just banging away, trying to get orders in. And then I get an email from Mike, and he was asking, how do I do the AVG stuff, right? And so Mike is one of his guys there, one of his mentors, actually had walked him through how to set it up so he doesn't keep putting in false orders, because the antivirus is buffering the buy signal, because it goes out on a port. And I don't know if you guys know anything about this stuff, but it goes out on a port, the antivirus picks it up and scans it. Well, the antivirus has a little trouble scanning it because it's an encrypted data stream, and it can't read the encrypted data stream. So it doesn't know whether it's a virus going out or coming in. It doesn't know what it is. So it delays it. And then eventually it'll just, on going out, it'll eventually just let it go. Coming in, it's a different animal. It's a whole different thing. That's why if you're running like a Mac and you got it coming in, you got a couple of other problems going on, because Mac does one thing to it and the PC does another thing to it, and it causes all kinds of delays with your orders. You put an order in, you think your order's in, it's not in. So those are problems. So, but anyway, so again, like on something like, getting out, I like to I pick my low, I put my stop, I have my amount of risk below that. Okay, I start, I'm looking at it. To me, I just picked this spot. That this is not really a spot where I trade. I would trade. Let me find one where I would trade. Let me be a little more accurate here. All right, let's look at this one. All right, yeah, I'm more likely to take this trade because it was a pretty good sharp push down and the time. So if you look at the time on this was around 12:34. So yeah, I'm more likely to take this trade with the low and the deviation line both being there, and I'd be happy to get my 2/4 now in this particular trade. And I know I'm rehashing some of this stuff. So I this is to me that is beautiful, absolutely beautiful to see that, right? So I'm getting in here and I'm trading. Now, if I wait for that crossover, look how much I've given up. I've given up, and these are small candles. So the ATR is relatively small here. It's like 4 cents at the end of the day. So, but sometimes you have much larger candles. Sometimes every candle is this size. And when every candle is that size, 4 candles, the whole damn trade's almost gone. So again, you can't wait for these moving averages. They'll ruin you. So this is a good enough here to take a shot. So I set my stop loss, my trailing stop loss. If we're going to do a trailing stop loss, you can do 10 or 15% below for starting out until you get used to trading, and then trading options, and then you're coming up in the trailing stop loss. It's always going to keep following. It'll keep following, and then right here it will stop, and then and the trailing stop loss is set up correctly. Just as an example, let's say you use the ATR and it was based on this candle. It's going to be just a little bit more than that candle because it's 1.25. So just keep this in mind. This is about the size that you might have, right? So this is now your trailing stop is right here. Now each time we go up every bar, this is now your trailing stop. Okay. And we go up, okay. Actually, it's going to set it from close. So now it's setting the close right here. Okay. Here, the close is lower. So it still stays on that candle. So the loss is still around here. Goes to the next one. Okay. Your loss is here. That's why the trailing stop is good. Trailing stop is here. Okay. Comes over here. Trailing stop is here. You're not getting stopped out. Now, as it comes back down, that doesn't change your trailing stop. Your trailing stop is right where that red line is. Okay, so when it comes back down here, your trailing stop doesn't push back down, it stays there. Okay, and you go back up, your trailing stop stays. You get all the way over to here. Now your trailing stop comes up. Okay, if you get stopped out now, you're still going to break even because it's not many cents in here. Okay, you keep going. Okay, keep going, get up here. Now your trailing stop is at the first deviation, the minus one deviation. Okay. And just keep your eye on that because even when I pull this down here, your stop loss is still here. So the 1.25, which I'm showing you in this entire example, come over here. Remember, my stop loss is still right here at the deviation line. Next one. Okay. I'm about same place. Maybe it moves up just a penny, moves up a little bit more. Yeah, and they have a really good setup in there, and it's easy to use. So then here you can see your trailing stops here. So once you put that trailing stop in here, and this paired up signal, I consider it good. A long shadow is an excellent signal. Okay, I love to see the bears lose on a candle at this point. This is a great signal. And I'm sorry, that each time we talk, I may add something like this because I can't remember it all. I mean, I just do this. It's like riding a bike. So here, now my stop loss is here. So for, let's do this. Let's just say here's the stop loss. It's already been set up. Okay. Now, if I were trading, just on like using this for the signal, then I would have been out here. So that's why I don't use this crap for signals. It just doesn't work. Okay. So here I put this red line here to show this is where it was. I'm coming across, still safe, still safe. Okay. And then on this candle right here, if that's not a mistake, and I don't know if that's a mistake or not, because sometimes the data gets all fudged up. So I don't know if that's a legitimate, I don't know if that was a legitimate, some dumbass with a ridiculously big order in a market order or not. I have no idea. 291.21. Yeah, see, it was probably supposed to have been reported as 295.20, 295.21. So this is probably just a miss in the data stream, and that happens. And you can correct that. You can actually go in and you can say correct the bar, and so when you're reviewing, you can actually go in and plug in the numbers and hit OK and update that bar. And you can call them and confirm that what the numbers are supposed to be. But anyway, so let's just say we didn't get knocked out of that bogus signal, because that's probably what that was. So here's our new high. Here's our new high. Okay, so at this point, we'll move this up to here. Okay, and so this is a real example of how the stop loss works. Here, we're moving up here, here, here. I'll go right here. I'm going to move this. This is your real-time exit where you're getting out. So you've entered in there. You never had to look back. You could have went to the watch the movies, right? I mean, honest to God, this is so simple. All right, so then we're coming across. Remember, this doesn't change, and of course, we didn't get stopped out anywhere here. Okay, so right here, take this candle, and I'm just going to take a whole bunch of. Okay, our stop loss. Okay, is that red line? This red line, not the vertical line. Okay, so the next time, right here, it'll get pushed up. That's why a trailing stop is a good thing to have. Learn how to use them. Coming across. Okay, so even when it comes back down here, as long as the price doesn't touch that line, we're still in the trade. Okay, so knowing that, I don't have to keep doing this. I'm going to just show you guys. I'm going to come over here. Okay, over here. Okay, the moment I get above here, I have to now, right? I can start moving this line up. Okay, so I can move this line up to here. Okay, and this is where. No, look, I've asked you guys to use like 10 or 15%, but ultimately when you get ready to trade, you're going to use the ATR value. The only reason that I'm not telling you to use the ATR value right now is because until you learn to read the current bar that it's on and use that number and make sure it's not a fluke, you're buying on the largest bar, and all the other bars are an eighth the size, right? Then the ATR value that you're looking at is not reflecting this size bar. So the better thing to do would be just take the size of that bar and use 1.5 times that bar as your trailing stop. But for now, just so that you can start getting some trading down, I'm suggesting the 10 to 15%. But if you want to tighten it up, this is what you do. So on the regular trailing stop, the number you're going to read, everything to the right of my mouse to that vertical line would not exist on the chart. So the price you're seeing here would be based on the average of that candle plus the ones behind it. So the problem is, let's just say, like right here, you got a whole bunch of these candles, and let's say they were right here. Well, but if the candles are going to start moving with this size height, then your trailing stop is going to be like this far away, and you would have been stopped out a long time ago. So when I created this line, I just did it off of the candle that was there, and I pulled it down about 25% more. All right, because I don't want to walk you guys through this and have you stopped out real early, because that's not what would really happen. So you can do that. You can actually just go back and look at the bars and just pick the larger bar if you want to go that way. Don't go in and change. You can change the ATR multiplier. The 1.25 works for the majority of the time. You just have to make sure all the candles are generally the same size. That means from the low to the high. It's not the body, it's just the low to the high. And if that's okay, then you can use the regular value that's right there. But if it's not, like if these candles are all uh, much smaller, and you just got one large candle and you're going to act on that candle, take the height of that candle times 1.25 and then use that number as your trailing stop. And that's what you would enter into the active trader, or DOM if you're using TradingView or something like that. All right, so right here we can see I move the line back up, and we can see we're getting close to stop out, if down the road. But let's just play it out and see where we would go. Right, so we're moving this up, and we would be able to move this up here. Okay, and now we start coming down. Okay, trailing stop doesn't go lower; it stays basically on where it was. I'm coming across, and same, still hasn't moved. It's still not going any higher. And then right here it would come up a little bit. Okay, and it doesn't matter, the line doesn't go, it does not get pushed back down. So you can see we're right there, and we're coming in, and it's just kind of dancing around. And here's what when I talk to you guys about consolidation, I like to go 5 or 10 bars of consolidation. If nothing's changed, I get out. So let's look at that. 1, 2, 3, 4, 5. I might have gotten out there. 10 would be the worst one. 6, 7, 8, 9, 10. Maybe that doji. So I would have been out in here, the way I trade. Okay, because the moment that I set the best apparent stop loss that I could have, based off of a really important line, which is the deviation line, the 1% deviation line, that to me is a pretty solid point. I don't feel like I'm going to get much more than that at this point. Over here, if I would have had the same thing and my line, I I would have still been in, because 1, 2, 3, 4, 5 lines. Okay, uh, I would have been looking at it, and that I'm not sure that would have been the place, because it's not quite the same as when I'm looking at these 4 nice big red candles. Here I got 2 red candles from the point that I entered. I would have a different feeling here. Yeah, I'm talking about emotions. This is actually more knowledge than it is emotion, but maybe I should say my perception is I have more concern with 4 red candles than I do with 2 red candles. So I'm more likely to act over here. Now, if I didn't act, right, this is going up and down, but my line isn't moving, my line isn't moving, and my line isn't moving, I would have gotten stopped out right here. Okay, so this is the way this trade would have played out. And I'm gonna get the value here to see what that would have been. Oops, wrong day. So let's see what kind of money that might have been, right? So we liked getting in right here. It was good information. It was a good tell, and we would have been stopped out right here. All right. So I'm going to go the other way so I can see the box. It's a little clearer right there. All right. So I see I would have picked up 88 cents. Okay. So 2 hours, 19 minutes, 88 cents. Now, for me, I call this a completely virtually uh, no stress trade. There's no stress in this trade. There's no anxiety. There's no fear. Okay, if I bought one contract, I bought 10 contracts, I bought 20 contracts. It's the same trade to me. Okay, and that's what I need you guys to learn. And I just gave you a really simple example. I just grabbed SPY. It's one of my favorites to trade. I gave you a great example on the trailing stop loss. So I'm going to back out of this for a minute. So again, multi-time frame, really important when you're looking at a multi-day swing. When you're going to get out, right, or you're going to do an intraday, this is what you do. This is how you do it. And again, I like to pick clear defined points. Um, and sometimes, I'm going to be wrong, and maybe I make a small amount of money. I make a quarter instead of two quarters. Sometimes I'm just going to take the two quarters and call it a day. Maybe something the work that I do is been all time consuming. So, but on this trade here, my goal is always to make two quarters, and when I can make more, I take more. So here I would have made uh, one, two, three, and a third of the four quarters. So I made more than 75% of the four quarters that I typically would have had on my chart. Well, now I am actually looking at the three different lines, so it's a little bit different. Yeah, actually, before I wouldn't even have taken this trade here. To be honest with you, this trade could not have happened in the past. It could only happen now that I've added that deviation line. Yeah, I would have more likely been taking that trade right there. And I've been giving up these trades. That's why I told V, yeah, V, I'm looking back at how much money I've lost because I didn't even occur to me to use that 3% negative or that 3% positive deviation. So, all right. So, any questions about any of this so far? Okay. All right. All right. So, cool. Yeah, I'm trying to be as clear as I can. All right. So, and you guys understand this is often referred to as a DOM. It depends on what platform you're on. I mean, boy, I've traded so many platforms, it's not even funny. But TradeStation, TradeView, whatever you're doing, it used to be TC2000, right? All you pick them, I've done them. But so they used to be just referred to this as a DOM, TD Ameritrade, or actually the developers decided to call it the active trader. And it makes sense because this is the whole activity right here. Whatever you find work wise, all the work out here drives you over here, okay, to make that's the trade. I mean, that's the thing. And you can see all the activity going on here. And you can see, you can see what walls you may have here. I mean, obviously I have more in the way of a wall here in the active trader at 45 cents than I did at 46 cents. So even if I overcome 46 cents, I've like, let's say I sold. So I sold a contract. Literally, instead of buying the call, I sold the call. So for me, my direction here, I would call this a wall, right? So, and you can on NASDAQ too, you can see the same thing. You can see when the wall is set up, because then you'll have all of the different different market makers in your list, and then you'll see all of them at the same price, and you add those all up, and it's a hell of a lot of contracts. So if you think you're gonna, like, you're over here and you're going to try and sell short or something, and you don't know how to interpret Nasdaq too, you're making a big mistake if you don't know how to interpret that. So with that being said, try not to trade short. You absolutely have to get an option contract. It's a lot less risk. And so the active trader, I went through that, and I've told you guys, you pick in here, you'll pick single, right? There's all different like these ones are all set up. When I go for some trades on low cap stuff, like a $2 or $5 stock or something like that, then I'll actually use this method of just basically a value offset. So if I put my order in here, I'm setting my stop loss at 5 cents, right? So if you want to use a cents value, and a lot of the contracts you're going to be trading at, quite often you'll find your contracts are going to be, around $1 or in this area. Most of the ones that you're going to find, and you're going to go, oh, man, how does that work out? Well, it's working out because of the delta you're looking at in the price range. So if you're looking between $80 to $120, you're going to often find your prices right around here at the 50 delta. So if you want to use something like a cents, then you can do a trailing stop with cents. And when you pick your number, you're always picking 5 cents. That's only 5 cents away. And now down here at 5 cents away, you would probably have been stopped out quite a bit earlier. You may have been stopped out right here. Okay. And so that's why, by the way, there was a study, not one study, there's been many studies that have shown that the traditional values used for stop loss on back testing have shown that those values used are probably the worst values you can use for the risk management. Because in the overwhelming majority of times, when the trade was executed by a trader that had a history of success, had they have just moved the stop loss a little bit lower, they would have stayed in the trade till it was a profitable trade. So it's probably important for you to understand that there's going to be key points all the way along this trade that you have risk, and you have risk from retail traders and you have active traders. Let me show you what I'm talking about. Oh boy. All right. So right here at this line, this was when it came up at this line, came close, like it came close to this line, you had risk. Uh, the risk is like if you're going long and you hit this line, it can drop down. You came up here, you see how you hit the VWAP and it dropped down. Now, for some scalpers, this is where today, literally, some scalpers got knocked out. Maybe not a lot of them, but a few of them. Because the scalpers that entered this, like some of them would have been entering on the VWAP or been entering on the cross. Some of them use a 3 and a 5 SMA. Some use, it depends on the combination. So some of them may have had a cross and entered right in here, and then they would have been stopped out right here. Some of them would have been entering down here. Just depends on where they're doing their EMAs or SMAs, and that's why I don't use those. But this is an area where you have a risk of being stopped out, right? And then you can see when you got to the 50% line, which is in here. Let me pull this down a little bit more. All right, so this one is not the 50% line. This one is the 162 and the one. Okay, so those are not lines to worry about. Yeah, anyway, so like here, the VWAP line, you hit it and it started coming down. So you need to understand that any of the lines in here represent a risk on bouncing back. So when you're in the trade, uh, if you think you're going to trade that with just a mental stop, you're making a big mistake. Two autos in there. So anyway, that's just another example. And then now in these charts here, I'm going to go to the daily. So again, like I said here, I don't particularly like this pattern. And by the way, just go search for this pattern. When you see this pattern, look what happens. And based on that pattern and that behavior, that pattern, you can see a lot of things that happen related to that. So, but anyway, in here, I can add the VWAP lines, okay, for the daily, or in this case, I would add the VWAP for the weekly or the monthly. And just to give you an idea of what that looks like, let me add it. So on this VWAP, I'm just going to go ahead and set the settings for. Okay. So you can see all these. Let me back it down one notch. Whoops. Wrong one. There we go. TV's back on the other side of the room. Wife didn't like the fact that I moved it. Okay, so here, just so you understand how this is working, what it will do is it will take the weekly, and then you'll have an intersection on weekly, then to weekly. So this is a much more difficult, and this is not my VWAP. This is the default VWAP. My VWAP will take these two here and these two here, and this one will add together, and it will create a fake candle. And so it keeps the trend of the VWAP more relative to reality, rather than bringing it all back to zero and re-averaging again. So I do a little different on the averaging. So my VWAP is not blotchy and crazy looking like this, right? So and I find it very useful. Okay. So I will go ahead and add to this a study so you can actually look at the daily. So if you want to trade daily the same way that you trade in intraday, you can. So I'll package all that up and send it to you guys, and then or I'll just drop it in the room. I was going to add more to the room today. I just didn't get a chance. I did add a couple of studies that have been up. They're fully updated, and uh, when maybe when I get back, if I get back early enough on Sunday, I'll go ahead and add the other ones because I want to put everything in the room that's done and up to date, and then some of the stuff that's already done that I haven't put in there. And then I think the best thing to do would be to go over each one. Like I say, this is not what I want, and it's not what I want to have you guys use. But I just want to let you know there is a averaging tool that I use that works really well for the VWAP. So it's all volume weighted. So anyway, so the same things that you're seeing with the other one you'd see here, and pretty much gives you this kind of the same way of trading. Now, that's great when you're doing a swing trade, so you can pick several points and take a good slice out of a couple of a block of bars, right? Uh, Now there's things that I don't have in here, and I'll add it right now just so you can see it. So let's add something like the two EMAs, right? Okay. So some people on some swing traders, uh, some swing traders will use something like the moving average, and they'll take that trade right there. They'll go ahead and jump in. All right. So when they jump in, they're actually this bar here is the reason that this is formed. So I say they jump in here, but they're not jumping in here. They can't. This does not have this cross, and to the end of when this bar is done. Okay. So in the morning when it opened up, this green line right here, the end of it would have been right down here. So it does not represent reality. What you're looking at is the past moving averages that have been averaged with bars up here. Because even the 5, like right here where you're doing a 520. So if we go 2 bars up, 1, 2, 3, 4, 5, all of the activity of the green line from here to here is averaged by all of these bars. And I guess nobody told the market that the market was closed. Anyway, uh, so they won't use this line exactly. They'll actually be used on the next line. Okay, so let me be clear. They're not going to see this, okay, until the end of the day. The next day when they see it's crossed, that's when they're going to take their entry. When they take their entry here, right? Okay, it looks good for them because it opens up here and it drops down. This is what most of those swing traders are looking for. Because remember, it's always going to be one to the right. So when at the end of the day, they don't take the trade here. The next day they take the trade. They'll take a trade, and on this trade, they're looking at by the following day for the trade to be finalized. So keep that in mind. That's the way they do it. Now, myself, I like to look at things like if I'm going to take a trade and I have nothing but like the Bollinger Bands and just the price action alone, I I, I would take a trade if the candle here is a long shadow in red, and I would be more inclined to take a trade below the value line. And I don't care about that cross because when I finally do move through that cross, I use that cross as validation. So by the time I get to the end of the day here, I've did nothing more than validate, that my trade was correct, and I don't need that for the validation on dailies because you see that immediately in your P&L. So there's just something to think about. So I will give you the tools so you can actually look at trying to take trades out of the daily the same way you can take out of the intraday period. So the tools you have here, you'll have in the daily. The only difference is the Fibonacci lines will not be based on this. It would be based on 5 times what you're running. So if you're running daily, it'll take 5 previous bars. So as an example, let me go back to this, kind of explain this to you guys a little bit. So let's just say right here is the day that we're trading, and this data doesn't exist. Okay, on open of this bar and on close of this bar, it will create the Fibonacci sequence and draw it. Okay, and it's not likely to give you a gap cloud unless there's a gap of 4% or more, and that's you can set. So you'll still have the Fibonacci sequence, but it's not going to be the Fibonacci between the gaps. So like if you had a gap, here you had an open, here you had a close, and here you had an open. So that's considered a gap. So it would give you this gap only if it's 4% or more, unless you set it to show all, then it will show you all. So anyway, that will be in the study that you'll get for the daily. So you can trade, and you can trade with the Fibonacci lines as support areas. And I know that some of you guys aren't familiar with the Fibonacci, and some are, and some have probably used them, some haven't. So if this is the area we're looking at right here, uh, so we're ending on this day. Okay, we're going to go to the high here, right there. All right, so the next day, this is a tool. I mean, I don't expect everybody to know everything on this stuff, but this is a tool that's often used by traders, and they'll try to trade to a range to one of these lines. Okay, now I don't do that on the majority of the time. It doesn't work for me. Just it looks like it's going to do something, and it just never seemed to work out for me. But there are times when those lines do become relevant, and it becomes more relevant. I'm just going to drop this here and then re-grab it. Okay. So, uh, to me, if the price had turned and came down, started to come down, then I would have drawn it this way, and then I would be looking if the price were moving down. Then this tool has value. Okay, but it has no value unless the price starts to cross through it. So if it's crossing outside of it, then it has no value. So the study that I will give you will actually plot this in accordance to the direction that the next bar starts to move. So if you're 2 bars in, then and it's down below, then it will actually flip it automatically for you. So the study does everything automatic on the Fibonacci. So again, you get the same thing. You get all the static lines that I use, and it's really good for trying to establish a slug of bars that you can take, daily bars that you can take out, or weekly. It will work either way. So that study I'll be putting out, and it could be it could be Sunday that I actually go ahead and post that in the room. And then when you guys get ready to review it with actual some references to some tickers, I will go ahead and do that. Okay, so what were the other things that we were going to talk about? We talked about a little bit about multi-time frame. Uh, I made it very clear on how the trailing stop works. Uh, okay, open range breakout. All right, let's do that. Now, the script is coded. Actually, my new one that's in the room is coded the same way. So it's not going to display, it will not display if you're in the wrong time frame. So if you look at, I'm going to show you this here real quick. So this study right here, this one right here, which you guys all have, uh, this study has, it's been coded so that if you're outside of the 1 to 5 minute time frame, it will actually tell you. But if you go to daily, if you drop it on the daily, and I did this because I seen several of you guys had this study on your daily bar, on your daily charts. And so I've recoded it so that now uh, what it would do is it will actually hide it, so you won't even see it. And I'll just show you what that is real quick. So hide on daily. So if you go to daily, it's going to hide it. So it's actually hide on anything greater than daily. So all right, I'm going to go over here and I'm going to change this over to intraday. Okay. And then one thing you want to make sure of is that if you're doing equities or options, you shut these off. You want to leave aggregation at market open, but you want to make sure these two are shut off. You don't want those on. If those are on, it will skew the data. It will, in fact, be wrong. Okay. I'll never get the click here on the mouse of these buttons right. Somebody had said, you can do this instead of that, right? And I keep trying, and I don't know why I'm having difficulty. All right, so here's Facebook, and here's an example. And I posted in the room. I posted instructions in the room how to interpret the lines. So as an example, and this one's set at 30 minutes. Now, there are some that you're going to trade with a 5-minute ORB. And there's some that you will do a 10-minute ORB. And you have to do your testing to figure out which ones work with what symbols. I can give you a couple as an example, but ultimately you'll need to know how to use the tools on your own. It's this way you're not going to be, you can't rely on me forever. So the goal here is to educate you to a point where you have self-reliance. Okay, so right now, in this particular one, this was written by Mobius. Mobius is about an hour from here. We both have worked on some coding together, and he is a very reliable coder. Most of his work is extremely reliable. So if you see a post from him on a study and you want to try it, feel free to try it. And if you want feedback on it, let me know which one it is, and I can tell you my take on it. Uh, some of his are targeted specifically for specific things. He is ES. Everything he does is /ES. So that's what he trades. And actually, let me show you what he trades and what he does. This is his baby right here, the E-mini. That's all he trades is the E-mini. Okay. And he has his own set of tools on here, but using this tool will work as an example, but then I'm going to go to Facebook. All right. So at this time period here, he got the green dots. The green dots after a certain period represented that this is going to end up higher. In other words, the close is calculated to end up above the yellow line. Okay. And so in this case, what you do is you'll take the trade. You can take the trade if it were below and it breaks through the yellow, or you can take the trade when it breaks through the green. And either of those are considered confirmation of entry of the trade. And so let's just say you were doing this and I'm going to, for argument's sakes, I'm just going to say, instead of $3,000, these are $1,000 and you did $10,000. Okay. So we're saying each contract's $1,000 as an example. So in here, as you're going up and you get to the first line, that's the basically the first resistance area that you're going to deal with. The second line is the first point where you're gonna sell part of your position. You're gonna get out. Now this is his strategy. This is not my strategy. So in this case, at this point here, what you're going to do is you're going to go ahead and take about 33%. Okay. So you're going to take 3 or 4 of those contracts and you're going to get out. Right. The idea is that when it hits the next one, you're going to unload another. Basically, I believe the next part is 50%. And then ultimately, the goal is when it gets to this line, you sell uh, half of what's remaining, then again half of what's remaining. And if it breaks below the line and it starts to go, then just get out and look, close the position. And this is his write up. And in fact, if you look at the study and you go into the study, he's written in here instructions for you. Okay. I've also put this in a HTML and put it in the room. Now, I actually have one that's a little more thorough from him on this because he did send back an email today. So I will put that into an HTML and then a page and drop it in. You can open it with your browser. The reason I like to put it in an HTML format is if you want to right click with your mouse and have it read to you, you can have it read to you versus in a Word file or a text file. If you don't have the adder in your software to be able to read a text file, it's not going to read it. So I like to put everything in HTML. So anyway, so here's an example. It's giving you about a 62% probability it's going to go up. Guess what? It went up. Okay. And then it creates these lines throughout the day. Okay. As things are happening. So, when it started to break this line, it plotted the new line. When it broke this line, it plotted the new line. And that's how it's creating the lines. Now, here's where I differ on my belief. Okay. I, this is my trading methodology, my mindset, and what I trade, and it's been developed because of keeping accurate records. Uh, From my experience and my own records, if I get here and I sell half the position size, or I sell a third the position size, or I sell any part of the size, I've made a mistake, and this is what my records show. And that's why, I did my best to give you guys your own trading journal so you can start keeping track. But the truth is that if if my target was say here to begin with, why am I taking a loss? I'm taking a loss anytime I lock in profit down below. And some people say, no, you're locking in profit. Yeah, but wait a minute. How many times does it hit that? So if the majority of the time, I'll pick a number, 85% of the time I hit this, that means I'm willing to give up all that profit, which is 66% more profit than from right here to here, right? So I have a problem with everything online and everything I read and everything that says about where and why you should take a little profit now. It doesn't pencil out, and you can do your own work. It's very easy to do some basic math. And if you're not familiar with Excel, I suggest you get used to it. But my numbers show that if I sell early, that I'm often, if I sell here at the first mark, right, or I sell even at the first resistance line, at which in fact many people say sell here, they'll tell you it's 1 to 1. You're taking here, your risk is 1 to 1. That's what they tell you. I What the hell do I want to do a risk 1 to 1? So that's why I prefer to do everything I prefer to do is with the options. But so anyway, so if I take the trade, if I entered here like everybody says and everybody tells you on this particular open range breakout, but my target showed that I should be getting out here or I should be getting out here, right? Anytime that I sell short of that number, and my records show that that number is achieved 80 or 90% of the time, look how much money I'm giving up. Now, if I pencil it out, if I figure out how much I would have made if I stayed in every time and how much I would have lost because it came around and took me out, because sometimes it will turn around and go right back down, right? So in 15%, if 15% of the time I end up with a wash, I get out, right? I'm up but I don't take a loss. If I'm up and it starts to come back down, I don't let it go back through and then give up 25%. if I was right, I was right. And the moment that it goes against me, then I was wrong. That's when I get out. So like if I've already seen a movement in the direction that I expected, I don't wait for it to go back down and then keep going and get out. I get out right here. So on 15% of these, I'm going to take a wash. But on 85 of them, I'm going to take this or I'm going to take that. You just put the math in Excel and you can see how foolish you are to break it off and sell it into shorter pieces, going up, trying to take profit as you go. It doesn't work out. It's basic math. And I suggest each of you try and figure that out on your own so you get a better idea on how that works. So I have a problem with what everybody, again, if you hear it online, you read about it in a book, you better question it. I think education is the best animal we all have. We can learn it, or we can master it. Maybe master the animal, right? It's like kaiju options. Master your monsters. So I was trying to create clever logos, and I had that one for a while. All right, this is Facebook. In Facebook, they're telling you his study here, and I didn't pick anything in advance here. I just put in Facebook, or it's popular one to trade. All right, so I got green indicators, which represent 66 or 62% of the time it's going to go up. Just past the yellow line is around 52 or 53%, because that's just the normal percentage that on the average every stock goes up 52.6 or 52.7%. That's the average year after year, flat market, down market. That's the number. All right, so right here when it clipped the corner and it came through and it passed this line, this is where you take your entry. All right, a lot of people say you get out here. Okay, a lot of people say you get out there. Okay. For me, if my target was here, I'm all out here. Okay, my target was here. Okay, I'm going to be in a world of hurt on this one because I'm going to end up coming back down here and getting a wash. Okay, now you can do a trailing stop as well. So if you entered a trailing stop in here, you probably stopped out right here, but it's better than a wash. So these are disciplines you have to develop. All right, so this is the ORB, and just for clarity, here's the kind of the rule. You don't go short when it's in the green, okay, and you don't go long when it's in the red. This is the thing that everybody says. I I have other problems with that, so that's why when I share this, I'm going to give you my take on how this should be traded. And if I'm coming down and I'm hitting this yellow line, and this yellow line is the previous day's, and sometimes this happens, if this yellow line is the previous day's close, I consider that a major support line. And so if I'm coming down and I hit it, certainly I want to buy long. I wouldn't go short, right? And if I pass through it and I get into it and I'm in the red, of course, then I can go short, and that validates the idea, right? But if I come up to the line and then I wait for it to pass, often you'll get a jump up or spike or a long bar real fast. And it's usually a good chunk of this range. So if you don't enter when it's at that line, then you'd miss that range. So in combination with the other tools that I've given you, there's times where you're going to go in defiance of what the rule is on this, because depending on the line where it's at and other lines you have on the screen, that may be the opportune time, the best time to enter in to take this entire range. As which is better, to take this little range and this little range, or take this range? So, and there's going to be times you'll see that after I get you set up with this. All right. Any other tickers you want me to look at with this so I can show you? Uh, LLY, right? Okay. All right. So here, you had an indicator. It broke through the yellow line. It came and clipped the edge. Here you would have went short. Okay. And in the short, the first range. And again, depending on who, you can go onto YouTube and look at ORBs. A lot of people tell you the first resistance, which is the first area you take profit. And some will tell you it's the second one. The ones that tell you to take it on the first one are the ones that are saying the ORB is good for a 1-to-1, a one risk to one reward. Insanity trading is what I call that. But anyway, so right here it's saying you go ahead and you're going to take the, right here, you're going to take that trade short and you're going to go down. Okay. Now today, when I told Andy had did a double buy, and that happens to all of us. And he was right in. It was I think it was right in here, and I said, I would just get out. There's a couple of reasons, but it not because of this. First of all, he didn't feel good about the trade. That's part of it, and not all of it. He didn't feel good about what happened, so it's already affected him emotionally. And so my idea is, if you have that on you at all, it's to get out of the trade because it's already affecting you. Okay. The other thing is there is some other information with the regular trading stuff that we have on our intraday, the VWAP lines and some of the other lines and the Fibonacci lines. There's a couple other lines here that show there was actually support right here. There, I believe there was actually, I don't remember which line it was. I think it was the 0 line or the 100% line. And so I said, just I would just get out because there's things here that are going against you. And so what I did was I added all the witnesses for and all the witnesses against, and I divided. And it was 52%. There was a 52% probability, okay, that it would go up, that it would go up, not down. And that's not much of leverage to be in a trade, in my opinion. 52% is not much. It's actually less than just the candle, but what the bar would be on its own without anything else. So anyway, he got out, and I think he got out somewhere in here, and then it came back down. And I didn't have this one. I wasn't using this one. I may have had it loaded, but I wasn't really using it because this is something I was doing something else with a SPY, with SPY and GLD. But anyway, so it came down and kind of ran on this and it came back up, and it just is coincidental that this red line is the same area as my the Fibonacci lines that I had laid out. But it actually came up and it tagged right on the Fibonacci. Actually, it tagged the Fibonacci right about here, and then these two candles had broke through, and I said, yeah, tweezers don't make the trade or something is what I posted, if I recall correctly. And the next candle looked down, or had dropped down, and it looked like, yeah, it was probably best to get out. And then later on it broke and it went up, and I think it was like, or maybe it was the tweezers right here. I said tweezers don't make the trade. And anyway, so then a few bars later, it actually broke and went up, and I just put in there, sorry, Andy, but I'm not really sorry. But my wife has asked me to try and be more compassionate and use more thank yous and more pleases and stuff like that. So I'm trying really hard because sometimes I just fall short of the emotional package that she would like me to develop. Anyway, so he ended up getting out, and of course it went up. Okay, and that happens. Those things happen. But the truth is there's going to be times where that happens. But in the bigger picture, like the larger picture, in 10 trades or a block of trades, how many times is it not going to happen versus when it does happen? So that's the way you have to trade. And so I gave my best shot on it based on the information that I had available. So anyway, but using this as an example, again, you had red, 62% probability it's going to close lower than open. The open was right here. And where did it close? It closed lower than it opened. Yeah, Annie, you're a mature trader, so I don't have a there's no problem here. So nor with you. So here, if you guys look, again in this area here, they say don't trade it, right? Don't trade it long. Okay. They'll tell you only take it short. Yeah, this is where I have a problem because the moment it broke this line, I'm like, yeah, okay. The moment it broke this line, yeah, it's a good trade up and to the other side. And the other Fibonacci line, I believe the other Fibonacci line was right here, and it came up and hit it and bounced off of it. So in my mind, I have a problem with the description on how to use this and not use this. And on compared to the intraday chart setup that I have, there's sometimes they're right, but when you combine them, often more times than not, when you combine these two, I actually find that with them combined, you have a better chance of making a more successful trade. So, well, let's put it this way, Ronnie. uh, I'm gonna abstain. You guys are young. You guys are young. I mean, come on, V, you're 24. Ronnie, come on. All right, so a little, uh, able to tolerate a little bit more. When you're older, you tolerate a little bit more. When you're young, you're a little more sensitive, which is tragic because then you go through, you get older, and then you become less sensitive. Then all of a sudden, when you get older, you become more sensitive, and then you begin to think what the golden years mean. And then you look at the older people around you all pissing themselves, and you realize the golden years means you start pissing yourself. So anyway, all right. So I like to use the ORB at different values, the 5 minute, 10 minute, or the 30 minute, and I like to compare the ORB with the study that I have given you guys for the intraday. And there's times where everything it's telling you about don't go long in the red and don't go short in the green is totally contrary to what I have and what I've experienced repeatedly. And I think the value here for me is that uh, between the two, it brings a more solid conclusion on a decision making. So when you're doing a scalp, if you have both of these in two different windows, you can see if they're working together, and if they're not, uh, why are they not? And then when you start weighing the number of times that they're not in sync, and you start recording that, then you actually begin to find that there's times when they weren't in sync. Okay, but it always had a certain outcome, and those outcomes then become tradable. So it's important to record the data. It's important to record things. It's important to do a screen capture. And sometimes on Toss, it's really important to do a screen capture because you got about a week before you can actually go back and on demand and trade that data because they delay it. It depends on what it is. Sometimes there's a delay. So when you go up to go to on demand, sometimes you can't go on demand the next day. So, and then you're going to be going, shit, I wish I knew where the hell was it? So again, the recording works and screen captures work, recordings work better. But anyway, so in this particular trade, again, the ORB tells you don't take this trade here. Do not take this trade. All right. But for me, it was like the moment it broke, then it's a different game. All right. The moment it was below and it's hitting, then it's, to me, it's short. And it's just like any other key resistance line. When you have, becomes the primary resistance, and once it broke, it became support. And so this is then you would use this as your as the line you would use to get out. Now, for me, I would take my ATR value below that line. I wouldn't use that line because if this would have turned around and came down and just did a little bit of a shadow, then you'd get knocked out. But if you use that ATR line below there and set your trailing stop, the moment you broke above your trailing stop, it would come up and then you'd be okay. And your trailing stop would have been all the way through. You would have been taken out right here on your trailing stop. And to be honest with you, once you get used to trailing stops or trailing ATR stops, or you learn how to set them up, and basically using some of the tools like ATR is a good one. Uh, Never use ATR for part of the risk reward ratio. A lot of people don't do it. I've ran test after test after test, and it's a failing trade. But it's great for setting up your trailing stop. Once you guys get that all going, uh, you, I mean, honestly, you could have flipped a coin and picked an entry here, and If you're doing stock, then you set up the same stop measure, and 50% of the time you're going to be in a winning trade, 50% of the time you're going to be in a losing trade. And with a trailing stop, you typically are still going to average a win. Yeah. Okay. So when we say penny stocks, let's take the word low float off. So penny stocks work well. Okay. Mid cap, large cap, all work well. But when you say penny stocks and you add the word low float, that's a different animal. It's a whole different way of trading. And that's yeah. So we got to keep that, always keep that separate. Those are different things. All right. So this is the ORB, and it's just open range breakout. And for clarity, so this is a 30-minute ORB. So if I come over here and I drop this to 30 minutes, you'll see why it's called a 30-minute ORB. Okay. This is the low, this is the high. You see these red and green lines? It's calculated and derived from a 30-minute bar. Okay, that's all that they're doing. So if you do a 5-minute bar, then it's obviously, you'd see the same thing on the 5-minute bar. And now if you were trading, right, if you were trading on the 30-minute bar, right, the moment the bar started to break, if you entered, the idea is it would go here, right? Now, I say, no, you can't trade here. You can't get long here. You have to wait until it's above here and then it comes back down. Then you can go long. Then you can go short. You can only trade short when it's in red. You can only trade long when it's in green. And it just, there's some problems with that from my perspective and my experimenting with it. So, I have a concern about some of that. And you'll see when you have both up on a screen what I'm talking about. There's times where uh, the data is conflicting between the two, but you'll also find that it's always the same places that happens, which is great because then that becomes something that's tradable. All right, so that's the open range breakout. Okay. Okay, what else were we going to cover today? Anybody have anything else that they want to cover? Yes. Okay. Let me open this up. All right. Has everybody seen this and used this? Or maybe just has everybody used this calendar? Only two of you? Okay. All right. So let's take a look at this. And first of all, if you click on here, you have the FDA calendar. So I want to go through both of these. You have the FDA calendar. Okay. And the FDA calendar, you can see phase 2, phase 1, phase 1 and 2, phase 2. Okay. So now this company offers a paid subscription, and I don't use the paid subscription because all of the data is already here. And and when I say that, uh, I don't assume anything on anybody's one site to be factual. I will actually go search for the drug. I will read about the drug. I mean, if I'm going to take a trade, and I know that it's a little bit different for you guys right now, but trust me, when you start taking a trade and you're putting 50,000 on the line, you're doing 100,000 on the line. Okay, you will put the work into it, because if you don't put the work into it, you're going to blow up some pretty large accounts, right? And so you do the work. So all right, so this is the basically FDA, okay, and in case if you don't know what PDUFA is, okay, there's explanation in here what each of these are, but I'm going to tell you anyway. All right, so basically PDUFA is it's already past phase 3. Okay, and it's just waiting for basically approval is what it's waiting for. Okay, uh, and there's some information in here, and you can actually do a little searching if you want more clarity on all of the aspects of that. All right, so as an example, like in here, it says Lilly, and then if you go down and you go into the calendar, you can see FDA approval announced June 4th. So it was already announced. So why is it here now? The same drug, it's already been announced. The approval's been announced. So it can only mean one of two possibilities. It could mean something like it's being repurposed. In other words, like from a pressed pill to a gel cap, right? It could be going from an an atomizer, okay, to an injectable. It could be any combination of those things, or it could be exactly what it says. It says FDA approval announced. So the FDA approval of the drug for phase 3 was announced. It just doesn't say phase 3. And what they're really talking about is it's now on track for new drug. And then that goes to so what that means is now the FDA has to approve the release of the drug, not approve that it passed phase 3. So this is in a little bit of interpretation here, and it's not a hard thing to figure out. So in this case, I believe what they're really talking about is in this particular drug, they've already got an approval of this drug. It's already on the market. What they're talking about, from what I could get, and I didn't put a lot of work into this, and I even posted in the room, I didn't put a lot of work into this. My guess is that it's a repurposing of this drug, some variation of the drug, or maybe added, like you can add a little codeine to it or something or whatever, whatever the combination is, but some kind of repurposing of the drug to be released. Typically, these things have little to almost no impact on the stock. Okay, the ones that have impacts are the ones that are under priority review. Okay, and the ones that are extended by 3 months, right? That's insane. Okay, the only reason a drug goes into priority review is because there's overwhelming proof that the urgency and need of the drug outweighs the short period, the period of time that basically it's they call it the short period of time, right? In other words, the one that takes a year or 6 months, and they go to the fast track process. It could be 3 weeks. It could be 2 months. It could be a month. But it's the fast track. So the ones that get this like a fast track approval, they're the ones that actually end up becoming something that's explosive, because there's a sense of urgency around getting the drug to the marketplace. And those ones typically command more money. So, like on a per pill basis or machine basis, they typically are able to get more money for those products. And those are stocks that typically are very explosive. So when you're looking at it, what I like to do is I'll copy the name. I'll just come across here and copy the whole thing, and then I'll paste it and then take the price out and search. I don't try to dig in here and get it right on, because when I'm going fast, this is what I do. I do something like that, Control C, and then I just back out the numbers, and I do a search that way. So depending on you, I mean, you may be able to get in there and get to the right you know icon of the mouse, and grab it right. But I just grab the whole thing and then I go post and search, because I usually have quite a bit of work to do every morning. Then, and these aren't something I have to do every morning. I might do this once a week, uh, sometimes every 2 weeks, but I don't have to do it every day. So this one's fairly easy. So when you go through these, you'll find some that are important and some that aren't. Now here's another one here. Okay, uh, MRK. Okay, uh, data under priority review. This is an important drug. Okay, this thing has some value here. Okay, and so these things you have to read up and see what it is, and because it has priority. In other words, other people that were already in the queue just got pushed back, and that pisses some of these other companies off. But this happens. Merck always seems to get a priority review. And so, Merck is a good, there's several in here to actually watch for. Okay. Uh, Due date the 27th. So it's done. It's gone. They've did their part. Now it's gone to an advisory committee. The advisory committee will vote. And now, whatever the advisory committee votes is not the decision. And that's another thing, too. The advisory committee is not the one who makes the decision. The FDA makes the decision. The advisory committee is kind of like the precursor of the final FDA. And again, I suggest if you don't know what these are, learn it, because in your career going forward, you will find that 25 to 35% of the money you make will be off of this calendar. Okay. And that's a fact. There's going to be plenty of pattern trades and things that you can make money off of. But these ones are the ones that will give you a 10-point bar out of nowhere. And you buy the option at real low IV, 15, 10%. And the next thing you know, the IV is at 180%. And you're going, why is this option so high? Right? And why am I getting so much? Because it's way outside any of the calculating stuff that TOS does. And you're thinking, is that right? Yeah, no, it's right. When the IV goes through the roof, the numbers all go to crap. They don't mean anything. So again, so this PDUFA. All right, back to FDA. And if you guys want to, like, one day just pick pick the whole month, and we'll do the whole month, we can do that from the beginning of the class to the end, and kind of walk through, or maybe just pick one or two and then walk from the beginning to the end. All right, so you're on this. This is basically the FDA calendar. So phase one, okay. This is only 1350. All right, this is the kind of stock on phase one. You read about it and listen. If it's another Botox, it's a good stock to short. I mean, how many variations of that shit can they come out with, right? Hemophilia B, right? When you look at the percent of the population to impact and the base cost on it, okay, it's it's just a showboat for their portfolio. It isn't going to have that much of an impact, right? Some of these things, and you'll get to a point where you will learn these things. I mean, you don't have to take my word. You'll get to the point where you'll read some of the stuff, and all of a sudden it'll start clicking. That's why I said to Jim C, Jim, this is a drug. You right now you can get this drug and get it going, and it will increase your wife's chances by about 3%. A 3% a hell of a big increase over not having 3%, and especially on a cancer that has a high rate of mortality. I mean, it's just a terrible disease to get. But anyway, so in here you go through the different ones, and phase three. Phase three is the last phase. Okay. If you short any of these that say phase three, you're a fool. I I cannot emphasize that enough. You are a fool. So let's look at price. Okay, 46.72, right? ARRY. Pull that up and see if there's options on it, right? If there's options on it and there's good open interest, it's a good one to do a sandbox on, or not a sandbox, an indifferent trade. So an indifferent trade is you're going to buy one call, one put on on, and if there's more leverage to one side than the other. In other words, let's say you have enough data to kind of push you to the side that it's going to push harder up than down, right? Then you would add more to the delta on that side. So you would do 60 on the call side and 40 on the put side if you had a little more push into one side. Well, where do you get that little weighted bias from? You get that weighted bias from the history. Okay, every time they had a gap, how many times did the gap go up versus down, and what was the percentage up overall on each of them? Because that's how you can develop a kind of a weighted movement on it, up and down. And once you have that weighted movement, then you can actually decide how to apply the delta. So if there's more to the downside, you'll get a put with a 60 delta, right? And you'll get a call with a 40 delta. So that's what you do, and you get it on each side. And what happens is when it has an explosive move, okay, usually you don't cash that option out to the end of the day because the ones that go short, they usually end up at the opening price by the time the day is over. So, and those are easy ones to do options on. You're not going to do an option on an option trade on a stock that they do 841, even if they have it. You don't just don't even bother. So you have to find and there's like Procter and Gamble, Merck. Those are all good. The larger value ones. So this one's this is priority, right? This is a good one to belong in. Okay, it's a good one to belong in. You just need to confirm that there's a value, okay, for the product. In other words, is it going to add? Is it going to take this? Is it going to take this $250 million company or $500 million company, and is it going to add another 50 million to the line, or is it going to add another $500 million to the line? And that just takes a little bit of work because there are plenty of comparisons to the value that the drugs are worth in the marketplace, and there's plenty of places you can actually get that data. And maybe what I ought to do is post some more stuff in the room on where to find that material so that you don't have to search as much. And then so BDF this one's not as important as the one with priority review. The one with priority review, they're going to get a premium for whatever the product is. There's a reason they get the priority. All right. Uh, NDA filing, right? Okay. This is a whole different thing. Okay. So NDA filing is basically it's a uh, okay. The PDFA, there's two parts of the review. You have the review committee, and then you have the FDA's uh, final investigative review. Okay. Sometimes when they're not in sync, uh, and then what will happen is, I mean, ultimately it's the FDA's decision. But sometimes when they're not in sync, they'll hold back, and so they'll do an NDA filing. And there's other reasons to do the NDA filing. And for more on any of these, anything that I'm talking to you about or pointing in here, just do a little search. You'll find, I mean, typically in Google, it will come up right away. NDFA filing definition, right? That's all you have to do. And then even PDUFA definition will come up first thing. It'll give you a good definition. So when you're going through these, there's some that you can just ignore unless you plan on doing low flow. A lot of these are low flow, and most of these are going to go bankrupt. Okay, I mean that's just a fact. Uh, but then you're going to have something like this. This is phase one. All right, Raj. Okay, so where was it? Phase one. All right, so like this one here, this is a Huntington's disease, a very small percentage of the population, and all this is okay. This particular one, uh, it it's just a marker. They're just looking for a certain marker, okay, and so now maybe that marker will give them early detection, but it's not a treatment. It doesn't cure anything. It's not going to add a lot of value to the stock, okay. And I can't teach you how to interpret these things. Over time, you'll know how to interpret them. And if you're in doubt, if you know definitively, then that's cool because you've been learning. But if not, assume nothing. Go do your own due diligence and search it out. All right. And so, again, here's another one. Okay, phase one, MAD due date. Okay. So I wouldn't be surprised if this is in the same biomarker, just renamed on two different tests, right? Because maybe it works on both, or some variation of the same biomarker. So anyway, so you have different things in here. Phase three, typically those explode up. Phase two, not that great. PDUFA. Typically, it's good, especially if the whole thing's been fast tracked. And again, I always look at the stock prices. 33 cents, phase 2B. All right, this is this is what Willie would call a red day stock. Okay, I mean that's just not my trade, but his. And actually, he may not even trade 33 cents. A lot of traders do trade 33-cent stocks. They just end up buying a couple 100,000, but it's the same ridiculous risks. All right, I mean, can you imagine buying a couple 100,000 and it goes up $3 on you? Jesus, you think you're only in it for 30,000 or 60,000, it goes up $5 on you. Look how much money's gone, if you even have that much money. Just an insanity, some of the stuff. Yeah. So anyway, so this is the FDA side of things, and you can see all the phase 1, phase 2, everything's here. The dates are given. I mean, you don't have to guess on any of these things. I mean, these things are so simple. This is pathetic. I mean, anybody. Again, I'm going to go back to Willie. Willie was trading stuff that was already scheduled to come up, and he's looking for it on a scanner. He didn't even have to look on a scanner. He could have set it on a pop-up on his workstation and pop up GNMX is coming up today, or whatever the hell it is. I mean, this is a lot of work, doing the scanning stuff on anything to do with the biopharmaceutical stuff is just ridiculous. So you don't have to do, if you don't have an application with pop-ups for notifications, let me know and I'll send you one. I have one that I wrote in Visual Studio. It works really well. And then, and I have some additional information you can put in there so you can actually see what it's all about. And that works really good. So like this one here, phase 3, due mid 2019. They're just giving you an approximate range, but as it gets closer, then they'll update the dates. Yeah, I'll send that out. And I'll zip it and then drop it in because it's a pretty good size file. It uses a database, and it uses basically it's an Access database, so you can keep as many records as you want in there. Yeah. Well, there you go. Yeah, I mean, you got the whole month. That's okay. So, and then you do know that you can actually add a note to those. I don't know if you knew that, Andy. So you can right click on the right side, uh, and let me show you. So you can actually write it over here. I believe if you right click, then you can add a note, and you can add as many, you can add 1,000 words in there if you want. So it's kind of nice. So you can add notes. So on my list, I keep on the phase 3 and PDUFA. I actually have notes on mine, and and the reason I have notes is I'll say in there, uh, this looks like historically this looks like a 3-day move. Yeah, yeah, I can do that. Uh, yeah, I can do that. All right, I'll do that here in a second so I can show everybody. 1 second here. Oops. Anybody have plans for the 4th of July? Oops. Okay. So come on, Andy. We're gonna have tanks and big fireworks forth. Yeah, I didn't want to go on this surprise trip, but Tara's adamant that we got to go. And so it's Orlando. I got a feeling she's going to take me to Disney World, which is not going to be fun. But I'm going to just put a smile on my face and act like I'm enjoying it and try to be hospitable. Oh my gosh. There you go. Yeah. Lamb. Get lamb sausages. If you haven't had lamb sausage, cut it into little pieces, dip it in the tzatziki sauce. Oh my God. Magic Kingdom. Is that the same as like Disneyland? I don't know what Magic Kingdom is. Oh, that's LSD High. I get it. Ah, got it. Okay. The lamb wasn't your friend, was it, Ronnie? Yeah. It's like anything. If your favorite is chocolate cake and you eat chocolate cake, one day you will no longer like chocolate cake. Yeah, oh yeah. By the way, my wife just came back yesterday. She got her report back again. Her cholesterol is twice what mine is, and she's like, "I don't understand this. It's not fair." Yeah, I think the difference, Andy, is free range lamb versus, there's a big difference between different. It's just like free range chicken. Free range chicken is great for chicken soups, stuff like that. Not all that much fun for just a leg or a breast off of a barbecue. Yeah, yeah. My wife is it's like she's getting mad at me because she's got a cholesterol problem. Uh, I don't eat a lot of bacon. She eats bacon almost every day. Uh, when she goes, she'll buy pork and she'll get this big piece of pork with a lot of fat on it, and she eats the fat. And I'm like, yeah, that's why Filipinos only make it to about the age of 42, baby. And I keep begging her to stop eating the crap that she eats, and it's not going to happen. I'm not gonna change the taste preference of hers. All right, so over here, what you do is right on the side. Okay, you can right click or left click, either one, and then you see this think notes on CLG. Create a note, and now you can enter anything you want in here. Okay, and what's really neat about it is once you've entered it, whatever it is you want to enter, right? It's there, and when you move off of it, you don't know that anything's there. You can go back in and then say think notes, and you can have different notes. You can add as many notes as you want. There you go. You can delete notes, and then you can also go into I don't do this that often, but yeah, all of the notes will be over in mm, yeah, there's a place that keeps all of your notes. Maybe it's over here. No, I don't remember. But there's a place all your notes are visible, so you can actually go read all your notes. And so, yeah, you can add any kind of note you want. The way you did that is pretty good on that PDUFA. And you can add, like I say, you can add the notes, you can add the dates. So everything's there. You can actually add the date, right? Which is kind of cool. And, that's kind of good.